that in the period 1970 to 1980, the US dollar lost 75% of its purchasing power. That's what I think happens over the next 10 years. In the 1970s, the gold price ran 30-fold. I'm not suggesting the gold's going to go 30-fold. I'm suggesting that if the performance of gold mirrors the negative performance of the US dollar, that the gold price could run 3-fold or 4-fold. That's what I'm saying. If you cut the interest rate too much, what happens is that the attractiveness of US dollar-based savings declines. Money flows out of US dollars into competing currencies or into things like gold. As the interest rate falls and the currency weakens,
Veteran investor and entrepreneur Rick Rule draws striking parallels between today's monetary landscape and the inflationary crisis of the 1970s, suggesting that investors may be witnessing the early stages of another significant devaluation of the US dollar. His analysis reveals a troubling pattern that could significantly impact investment strategies for the coming decade. The 1970s offer a sobering precedent that validates Rule's concerns. The dollar lost 75% of its purchasing power between 1970 and 1980, while gold surged from $35 to $850 and silver climbed from under $2 to $50. This decade-long bull market, despite significant corrections like the 1974 to 1976 pullback, demonstrated the effectiveness of precious metals in mitigating monetary debasement and established a historical blueprint for navigating currency crisis periods. Historical context reveals the broader scale of dollar degradation that underpins Rule's thesis. Since the Federal Reserve's establishment in 1913, the currency has lost over 96% of its value through systematic devaluation. The devaluation mechanism Rule remains fundamentally unchanged from the 1970s experience. When central banks expand the money supply without creating corresponding value, each dollar becomes worth less in real terms. Gold's finite supply and universal acceptance enable it to rise in compensation, preserving purchasing power for holders through currency crises, a dynamic that proved remarkably consistent throughout the inflationary decade. Despite this historical precedent, Rule sees substantial potential ahead while maintaining realistic expectations. Rather than expecting the 1970s dramatic 30-fold increase in gold prices, he projects a more measured 3-fold or 4-fold rise if gold merely keeps pace with dollar devaluation. Before we begin, make sure to like, share, and subscribe. Tap the subscribe button and hit the notification bell so you never miss out on our latest market insights.
So let's unpack that. I would make the argument that gold is cheap. Gold does well when people are concerned about the maintenance of their purchasing power in fiat currencies, in particular the US dollar. I would suggest that as a consequence of the deficit, that the US dollar repeats its performance of the decade of the 1970s, where it lost 75% of its purchasing power. If that's true, it wouldn't surprise anybody, I think, if that's true, to see the gold price mirror the decline in the US dollar, which is to say go up 3-fold or 4-fold. How far has gold come? Yes, it's come a long way. Remember how far gold ran in the decade of the 70s, the last time the US dollar lost 75% of its purchasing power. In gold bull markets, gold stocks follow gold. Gold has moved, but the gold stocks, with the exception of the biggest and the best, haven't moved very much at all. The biggest and the best have moved, which is indicative of about the first quarter of a gold bull market. The best of the best moves, then the best of the rest moves, then it goes down the quality chain. You're seeing farther down the quality chain. You are seeing the best of the tertiary companies in the space. They haven't moved yet at all. They are, in fact, cheap if we're in a gold bull market. It is that if you took a net present value of them a year ago with the gold price that existed a year ago, the net present value of their free cash flow at $2,200 gold means that their free cash flow valued at $3,300 gold, in fact, if you do price cash flow or price net asset value, they're selling at lower multiples today at a higher price than they were back then. The price, not the price, the margin that they earn at today's gold price is so much higher than the margin that they earned at the gold price that existed then, that despite the fact that the stock is up 100%, by any reasonable valuation metrics, they are cheaper now than they were then. The circumstance that we're in the United States, with $37 trillion in on-balance sheet liabilities, or as Stockman pointed out, $29 trillion net of the Fed's own balance sheet, and $100 trillion off-balance sheet liabilities, it would appear to me and to David that the only way that we honor the nominal value of our obligations is to devalue the purchasing power of the dollar. We did that in the decade of the 70s. The Office of Management and Budget, which he was the head of, tells us that in the period 1970 to 1980, the US dollar lost 75% of its purchasing power. That's what I think happens over the next 10 years. In the 1970s, the gold price ran 30-fold. I'm not suggesting the gold's going to go 30-fold. I'm suggesting that if the performance of gold mirrors the negative performance of the US dollar, that the gold price could run 3-fold or 4-fold. That's what I'm saying. The interest rate is the compensation that private sector investors receive for tying up their money and for inflation. And this is really the crux of the issue. If you believe the federal government's measure of inflation, the CPI, you're in fairly good shape. You are getting paid 4.5% in the US 10-year Treasury in a currency where your purchasing power is declining by 2.5%, meaning you're making a 2% real yield. I don't happen to believe the CPI. When I look at the basket of goods and services that I consume, Paul, or that you consume, my belief is that the underlying rate of deterioration of the US dollar is more like 7.5% or 8%. If you cut the interest rate too much, what happens is that the attractiveness of US dollar-based savings declines. Money flows out of US dollars into competing currencies or into things like gold. As the interest rate falls and the currency weakens, gold does well. Now, it's interesting that at the same time that Trump is for lowering the interest rate, he has also said that a lower US dollar would not be a bad thing in terms of export competitiveness. We saw this before in the decade of the 80s, where there was successive currency devaluations by various governments. One of the things I like about gold is it is one of the few mediums of exchange in the world that doesn't have a domestic political constituency for devaluation. If we devalue the dollar, our exports become more competitive in Europe and Japan, which gives them an incentive to devalue the euro and the yen, respectively. What's lovely about gold is, as I say, there's no political constituency for devaluation. Among other currencies, on occasion, you have an incentive for a race to the bottom. I'm surprised that there wasn't more of a discussion of interest rates on the macro panel. It would appear that there's intense political pressure on the Fed to lower the interest rates. At the lower levels of the Fed, the Federal Reserve believes that they're the only institution of the US government that's involved in defending the dollar. They believe that Congress has totally lost the plot, and it's only the maintenance of relatively high interest rates that's defended the dollar. I remember myself very well in the decade of the 70s, when interest rates were allowed to rise some to kill inflationary expectations in 1975. That rise in interest rates was fairly steep, and it really cracked the gold price for 9 months. It also cracked the equity markets, obliterated the debt markets, and hurt the housing markets. When the political forces lost their courage, cut interest rates to re-stimulate the economy, gold was off to the races. Wall Street knew the government is not going to defend the dollar. The dollar's toast. Here comes gold. If they succeed politically in causing the interest rate to fall, the gold market will take a real romp, similar to the romp that it took at the end of 1975 through 1976.
Rick Rule challenges conventional stock valuation by demonstrating that Agnico Eagle offers better value today, despite its share price doubling over the past 18 months. His analysis focuses on the net present value of the net rather than historical price comparisons, revealing that the company's intrinsic worth at $3,300 gold far exceeded its value when gold traded at $2,200. Agnico's outperformance stems from superior cost control while competitors struggled with inflationary pressures. This operational efficiency enables the company to capture a greater share of gold's price appreciation as pure profit margin expansion, particularly valuable when effective cost management separates industry leaders from laggards. The mining sector has benefited from favorable conditions since 2024, with lower oil prices and reduced inflation helping to arrest the cost growth that previously plagued precious metals miners. This environment creates ideal conditions for well-managed companies to demonstrate operational leverage in response to higher gold prices. Comparative analysis reveals Agnico's superior cost management. All-in sustaining costs rose from $938 per ounce in 2019 to $1,239 in 2024, representing 5.7% annual growth. Meanwhile, Newmont's costs increased from $987 to $1,444, and Barrick's from $894 to $1,484, both exceeding 10% annual inflation. Let's get back to the interview.
In the early 1990s, nobody paid for optionality. It was free. When Rudy Frank built Seabridge, he acquired KSM for $300,000. Nobody paid for optionality. When we built Vista, we could buy ounces in the ground for $1 an ounce. They were worth nothing on a net present value basis, but you got the optionality for free. When Ross Beatty built Lumina, you could buy copper deposits that majors had spent $90 million on. You could buy them for $2 million. Optionality has a price tag associated with it now, so I'm less attracted to it. That doesn't mean that these things won't trade up. What it means is that optionality was a better deal when you got it for free. It's a less good deal now. Now, if you're looking at real gold companies as opposed to the pretenders, let's look at Agnico Eagle, a boring stock. I love boredom. Back of the envelope calculation, if you do a net present value on Agnico Eagle and you use a $3,300 gold price and you model the cash flows out 5 years, 10 years at today's prices and costs, the stock is actually cheaper relative to $3,300 gold than Agnico was at half this price 18 months ago with $2,200 gold. Because if you use $2,200 as the baseline for doing a net present value calculation, the net present value number that you get is materially lower than you get if you use $3,350 as a baseline. For real gold companies, the leverage to the gold price, which you enjoy next year, next month, is much higher than the real optionality you get on gold price on the gold price for deposits that may never go into production, or if they do, will go into production at a gold price scenario which could be materially higher or lower than today. What will change is the stupidity of investment markets and the willingness of speculators to overpay. A deposit with the average grade of seawater that has some gold and has fairly high upfront capital costs will come to be valued in the market on an in situ value per ounce metric, which from an investment point of view is entirely irrelevant, but will matter to speculators. There was a time in my youth when I thought I was smart enough that I could trade against the expected stupidity of my counterparties. I don't do that anymore. I do absolute valuation. I'm uninterested in monetizing fiction. In the exploration companies, you are modeling the probability that what will become the net present value of the asset 5 years from now is materially higher than the enterprise value today. That's a process of anticipating and measuring the probabilities of the answering of unanswered questions over time. If the company's target, you think 5 years from now, will have a net present value of $1 billion, and the market capitalization of the explorer today is $50 million, you need to decide what is the process by which the market gets certain of that $1 billion valuation. And what is the probability of the successful completion of every unanswered question in the process between here and there? It might be that for an exploration stage company, that they have a large mineralized anomaly in northwestern BC. They've done surface sampling, grab sampling, by nature selective, and they've outlined a large mineralized anomaly. The first question might be, is that transported gold or is it in situ? And to answer that question, they might need to do a trenching program to see that the gold extends through soils into bedrock. And it might be that they need to do an extensive trenching program. That would be the first unanswered question. In other words, is this mineralized anomaly ubiquitously mineralized, and is it mineralized at depth? And you would try to gauge, A, from the experience of the people asking the questions, and B, from the nature of the surface sampling program they did, what's the probability that the trenching program will give them a drillable anomaly? And it might be that you decide that it's highly likely that this will occur, highly likely. And so you will speculate on a yes answer. Let's assume you get a yes answer now. You have refined your knowledge of this thing from selective grab samples to systematic trenching, and you have a legitimate mineralized anomaly. Now you need to test the third dimension. You need to say, does this extend to depth? And what does the grade profile look like at depth? So it might be that you propose to test this with a 10-hole drilling program. Again, you as a speculator need to look at what a yes answer is worth. In other words, if they have a reasonably successful 10-hole drilling program, and they define a resource, which hasn't been measured or indicated, but they've defined a resource. What is the market likely to pay for that? And what is the probability of success likely to be? So let's say, just for fun, that you have a 10-hole program, which turns out to be a success. Then the next thing might be, okay, so now we need to drill it off systematically. We need to test depth extension, strike extension, width extension, and depth. In other words, we need to develop a target size. We need to begin to move into the PEA status. And that might be a 50-hole program. Again, you try to determine what the yes answer is worth and what the probability of achieving that yes answer is. Mercifully for me, most of my competitors are unwilling to do all that. Most of my competitors pursue a strategy called got a hunch, bet a bunch.
Gold is gaining more attention as people become increasingly concerned about inflation and the erosion of the value of money. In times like these, gold is often regarded as a safe means of preserving wealth. Even though the price has increased, many well-managed gold companies still appear undervalued, given their strong future earnings potential and expanding profit margins. As the global economy remains uncertain and trust in paper currencies continues to erode, gold is likely to see even greater demand and upward momentum in the months ahead. Could this be the start of a powerful new rally for gold? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. Tap the bell icon and enable notifications to stay updated. Your support enables us to continue delivering the latest market insights to you and the broader community. Thanks for tuning in.